Before I start, I would like to introduce you to SNL Metals and Mining. SNL Metals and Mining is a global mining data provider covering the entire universe of mining, from companies and projects to M&A activities and exploration budgets. During my presentation, we'll go quickly through mining sector summary. Then we'll touch base on commodity prices, exploration, development, projects, financing, and we'll finish with situation with merger and acquisition. Before we start, a summary of the sector, which is mostly about moving valueless rock and dirt. Ore comprises metal and process waste, so the valuable material is only a small fraction of the extracted total. Based on 2013 average commodity prices, coal, iron ore, copper, and gold are still dominating the world production. Mining industry can be split into three almost equal sectors by value of output. It's metal and gems, coal and cement, and industrial materials. According to SNL database, around 90% of the value of the world's annual production is produced by only 2,000 mines. It is not a big industry in terms of the major contributors to mined output. And half of the companies have a market capitalization of less than $10 million. Commodity prices peaked in 2011 and went throughout 2012 before stabilizing somewhat in 2013. Nickel has done best recently, all thanks to export restrictions by Indonesia in January 2012. Gold prices are widely expected to keep falling through 2015 unless we will see an incredible strong physical demand, potentially from East Asia, if it keeps growing the way it is growing at the moment. However, we must always take long-term trends into consideration. The real inflation-adjusted price of gold in sterling can be measured back 740 years. Last year, it was just above 1,000 pounds per ounce for the first time since 1,500. Global economies are recovering, but the improvement is not yet reflected in metals prices or minerals exploration activities. This chart illustrates the number of properties reporting drilling results each month. Drilling activities fell again in 3 months to end March. In Q1 this year, exploration is at only 56% of year-ago level, which was itself 62% of the number of projects reporting drilling in Q1 2012. This map shows distribution of drilling activities during the past 26 months. And we can see that so far the most active ones still Canada, Australia, followed by United States. Exploration expenditure follows metal prices. This graph excludes coal and iron ore. The index metal prices shown here is weighted by the percentage of exploration expenditure dedicated to gold, copper, nickel, and zinc. Exploration for all metals was down 29% last year at $15 billion. Exploration for gold has followed the metal price particularly closely. As a result, there has been a sharp decline in projects reporting drilling results quarter on quarter, which is reflected in the announcement of new mineral resources and ore reserves. As we can see on this chart, that Latin America remains the most important region for overall exploration. Junior spending has been particularly hard hit. Their budget, represented by the brown line, fell 39% year on year in 2013, with their share of overall exploration falling to 34% from an all-time high of 55% in 2007. Grassroots exploration, that portion of exploration dedicated to discoveries away from producing mines, has been on long-term downtrend. However, it is picked up slightly to a third of all exploration last year, after falling steadily in the past 10 years from over 40%. This graph shows average exploration budgets in relation to companies' revenue for the largest producers. Overall budgets fell to 2.6% of corporate revenue in 2013, down from 3.5% the previous year, but still well above the low of 1.5% in 2004. Resources discovered have been falling in recent years, but new gold tonnage did increase in December quarter, only fall again in the 3 months to end March. Gold reserves, which is the most reliable deposit classification, has followed a similar trend to new gold resources. In terms of projects where a mine development has been announced, only 95 projects were announced internationally, excluding Russia, China, and India in 2013, with planned life of mine capex of $38 billion, compared with 113 new projects, with capex of $47 billion in 2012. But there has been an improvement in capex commitments and in the past 3 quarters. Turning to financing, barely 6% of the companies raised 85% of the capital in the March quarter. Capital markets are closed for juniors and mid-sized companies, and they are currently facing a liquidity crisis. Looking at M&A deals, geographically, China and Canada dominated in the March quarter, with an active focus on copper and gold. Number of M&A deals dropped to 62 in the March quarter from 76 in December quarter, but the value of these deals rose 66% to $12 billion in the 3 months to end March. Despite the continued shortage of finance, acquisition actively looks to remain strong in the current quarter. However, until funding improves for small and medium-sized companies, much of this likely to take the form of joint ventures and earn-in arrangements. Thank you very much for your attention.